2026 continues without a single dull moment. Now is just more geopolitical conflict in the world, and something that really has some implications for the investment world, for markets. And that's this Iran conflict that we just got into. Hunter, I'm excited to break this down for you and our listeners today.
Yeah, absolutely. I think this is something that's been forecast for a while, that there have been hints at, and generally the markets don't care too much about geopolitics, but certainly whenever there's anything that's this, forward, that this is this impactful, it also affects, huge shipping lanes, primarily for oil and gas, as we'll get into later, the markets start to take notice. So I am excited to unpack it, and obviously the markets have had some mixed feelings here and there, and will be important to take a look at where we are and what we expect for the markets going forwards.
Exactly. And we've seen some very volatile markets just in these early days of this Iran conflict, as market participants and investors try to figure out what are the implications for this conflict, how long is it going to last, how deep and how expansive is the disruption to normal trade. And as you mentioned, typically the Middle East doesn't have huge economic implications. They don't do a lot in the form of world trade outside of what we're really going to be focused on today, and that is oil and gas, but predominantly oil. And Iran is in a very unique spot because they have huge exposure. They're right on the edge of the Strait of Hormuz. And the importance behind that is that about 20 to 25% of the world's oil travels through that strait. And so if you have disruptions there, you're going to see huge disruptions to the global oil supply. We've already seen an increase in oil prices because of concern around this disruption.
Yeah, and Iran has stated that they are closing the strait because that's their big piece of leverage, kind of as you outlined. There's that because they have access to this strait and can take broad control over it, they have decided to close it. However, I will draw the distinction that just because they have said they're closing it, and the fact that we don't see any ships going through there, do not mean that they are capable of actually closing it. What we're seeing right now is predominantly due to insurance rates, because all of these obviously huge ships carrying huge amounts of valuable goods, require insurance. And so whenever there are wars or increased pirate activity, as we saw a couple years ago, insurance rates will increase until the situation is remediated in some form or fashion. And so that is the main holdup right now, is that not so much that Iran has much of a naval presence anymore. The U.S. has done a really good job in eliminating that, but it's because it's an active war zone. Insurance companies are jacking up rates because they don't really want to take that risk on, and I can't really blame them for it.
Yeah, all of a sudden your risk calculation grows a lot when you have missiles and drones flying over you. So, and while we haven't really seen Iran necessarily target, oil vessels, to this extent, that concern does exist for the insurance companies. And I think that is the fascinating thing about it, is that it's not necessarily because these companies aren't willing to take the risk, because, if Iran's looking for, an easily, targetable asset, they're not necessarily looking at some kind of oil tanker that's going through the strait. But we did get some developments on this very recently. So, the U.S. Trump administration said that they would they would either provide insurance or back the insurers in providing some kind of insurance to these vessels as they go through the strait, in order to keep the flow of oil, propping up the economy, preventing the biggest disruption. As you said, I think leverage was the key term there, is that's Iran's leverage. If they were able to stop oil transport through the strait, that's when you would have significant disruptions to the global economy. And we'll kind of get into how oil plays into that. But just to outline the dynamics, and then the U.S. has also floated, no pun intended, but security transport, with military vessels of those oil tankers through the strait. So it looks like, the U.S. is really working to take that leverage, that bargaining chip from Iran away. in order to continue their campaign. And so that's a positive view in the eyes of the market as well, because if you can, lessen that oil disruption, then you don't really have much more economic fallout from the oil disruption and the disruption in the strait.
Yeah, and I think an important thing to note is that going around the strait adds about 10 to 14 days onto transit times. So we're not going to see a total elimination of oil moving around the globe. That's not going to happen. But that adds costs, adds complexity. It, briefly at least delays those oil shipments from getting where they need to. As far as more permanent lockups, we've seen a couple small things. Iraq had to close down its largest oil field, which is the second largest in the world, because their storage tanks were at capacity, and they're right on the that's how they get to market, is through the strait. So they haven't been able to, and we've seen some liquefaction processes in Saudi Arabia close down briefly. None of this can't be pretty much immediately reversed. I mean, if the strait gets flowing again, Iraq again has their storage at capacity, so that can flow immediately. But as we sit, there are a few things starting to be taken offline, which is tangible decreases in global oil supply, at least in the short term.
Right. And we've seen, as far as price movement, commensurate moves in Brent and WTI crude. It hasn't been too dramatic. We were coming off of relatively low oil prices, which I guess in the grand scheme of things is positive, because you weren't coming from an elevated base. Yeah. You're going from relatively low oil prices. So Brent's trading in kind of the mid to low 80s at this point. You did see, a fairly significant bump just from the start of this conflict, but that's already starting to fade to some extent as the U.S. continues its dominance, and the risks to these vessels and the situation in the strait kind of relieve themselves. The base case here, I think, is we're looking at some kind of multi-week disruption, but it's not looking like an extremely long-term issue. I think what's going to be more impactful in the long term is how quickly Iran is able to, stabilize and then ramp up their oil production to a point, because of course that's getting disrupted at this point as well, especially as they go through administration change. They're going to have to sort out their economy, and part of that's going to be the oil production that is their, number one resource that they have in the country.
And I think an important thing to call out here too with the Brent and WTI moves is that it's much easier to buy oil electronically with a click than it is to actually transit it across the globe. So whenever you see one-day spikes and then commensurate, maybe pullbacks a little bit, renormalization of those, a lot of that activity is hedging activity. It's these oil companies saying, hey, if we, can't get oil to market, or if we, can't buy oil, we can, hedge ourselves a little bit in one direction or another. And so you'll see the electronic price move pretty quickly sometimes, even if that's mainly for hedging and not really driven by underlying, tangible effects that they're facing.
That's a great call out, because these oil companies are operating typically on futures contracts, so deliveries of this oil forward, and so hedging that out I think makes a lot of sense. What I want to talk about now is how this really more impacts the U.S. market, and talk S&P 500, what it does to Fed calculus here, the moving parts behind that. And I think whenever we're looking at, as far as economic impacts here, how it might drive our economy, you do have to consider the inflation risks that are carried with higher oil prices. Oil is an import into many of our industries. And so, if you had sustained periods of higher oil prices, of course, you're going to have, number one, higher headline inflation, because that's including those food and energy categories. But two, it can kind of trickle through to your consumer goods, to some industrials, things that industries that use a lot of oil. Of course, if those costs rise, they're going to have to increase their prices to maintain their margins, which in that case would increase inflation kind of across the board. Now, I think it's a little bit too early to start, making that call necessarily. But if we did see or foresee a period of sustained higher oil prices, I think that's something that we'd have to consider.
Exactly. And that kind of affects both like you said, directly affects the headline, indirectly, but also still fairly directly. It impacts the core inflation, but it also affects people's, ability to consume because higher prices. It affects companies' ability to, throw money into R&D investments. And so it can have a inflationary, but also an effect on growth too. So if this was a longer term thing, we could see growth slow down a little bit. I don't really anticipate it going on that long, but just kind of looking at it textbook view, what are the effects of higher oil prices? Will that be higher inflation and probably some amount of lower growth combined with that? Because energy prices are already difficult as far as electricity goes. But like you said, it's good that we're coming off of a low oil cost base when we're going into this.
Yeah, and I'll also circle back to the fact that the U.S. is relatively insulated from this, at least from our perspective, even on energy production, because we produce so much of our own oil here in the United States. We're essentially self-sufficient in that regard. Of course, our oil prices are going to trend with worldwide oil prices to some extent. And the good thing is that the Permian Basin is capable of ramping up production in order to offset at least some of the decrease across the world. That's and over the last 10, 15 years, it's been the most flexible oil field in the entire world and has really helped balance out disruptions in supply and demand across the world. Now, kind of going back to the inflation piece, I'll just make a quick note because we have focused so much on the Federal Reserve. Of course, if we do see sustained higher inflation, it does push out the likelihood of interest rate cuts. I think most members of the Fed are going to see through this. They obviously see it as a short-term disruption as long as it stays that way. And so far, it's looking like this isn't intended to be a drawn-out conflict. So I think they're going to, take a grain of salt whenever they add that to their, rate cut calculus. But I think it's worth noting because the Fed and the directionality of the Fed are impacting so much of the broader investment thesis right now.
Yeah, and the Fed's been pretty good recently about looking through these one-time shocks, even tariffs, which were a one-year shock in their mind, one-time price increase, but not an inflationary pressure, as it were. They've been pretty good about looking through that and pretty open about looking through that. And so I think something like this very much falls in the same bucket. Something that's easy to kind of look past for them when it comes to that inflation number. And one more thing on that, just being that we weren't really expecting another rate cut until about mid-year anyway. And so I think this is going to give them plenty of time and leniency to look through, but also just chronologically get through this effect before that would really have much impact on their next rate cut decision, assuming our base case that this is a pretty short-term price disruption.
Yeah, and we can get into some kind of scenario analysis here in a few minutes. But first, I'd love to talk about individual sectors, what we're watching from our perspective as asset allocators, as active investors in the broader market. And first, I think we can look at energy, upstream energy. I just mentioned the Permian Basin. I think those are going to be the players, U.S. domestic producers, who are really going to be the ones who benefit. Now, if you're operating on the international stage, it may be a little bit more questionable. But I think the Permian is going to benefit from increased volume to offset anything that's lost via shipping or via just Iran's production. So I think those are going to benefit now. Granted, I think we are in such a volatile period where I wouldn't just be loading up on those companies at this point. You've benefited if you've already held those. But I think the space is probably a bit too volatile to, say go full send and really, lever yourself to U.S. producers because of the, risk in this case that the conflict resolve itself extremely quickly, and then volumes come right back down, expectations get brought in, and prices kind of pull back in. So I think that's kind of how I'm looking at least the upstream energy sector.
Yeah, and similarly to that, your midstream, your oil transportation, both pipelines, but also in this case shipping would be a lot because the U.S. will be, obviously doing everything it can to ship more to especially Europe at this time because it's relatively easy. We don't have to deal with the strait, and we, like you kind of mentioned earlier, the Permian has always been that kind of, or not always, but for the past couple of decades has been really that marginal barrel of oil on the global stage. And so if you have Middle Eastern countries stepping back from that or unable to deliver that, then that's going to be, produced by those upstream Permian companies and shipped via midstream. And so I think watching that is going to be important because I think they're going to have, very likely to have higher volumes, which, obviously is good for their business of transporting crude.
Right. And I think, you kind of have to similarly look at refiners. It's going to depend on what the spread is between, the finished products coming from crude oil and the barrels themselves. Usually those spreads remain somewhat steady, but could expand if we have, further disruptions in this oil supply. I'd say that refiners aren't going to be the biggest beneficiaries of this situation or necessarily hurt that badly by the situation. So I'd say they're kind of in neutral territory.
And then I think taking a look at like industrials and also to an extent consumers, because industrials, like we said earlier, that's going to be a cost input. Some industrials more than others. Your heavy industries that consume a lot of oil and gas, or oil and gas for the sake of refining steel, high temperature applications. But also your petroleum based products too are going to play in. All of your plastic products are included in that, and so they're going to have cost input pressures from a number of angles. And then on consumers, it'll be, either an inflationary shock, really kind of as we were talking about, and if prices go up, they'll be consuming less. So you're looking at those staples, those cheap consumer goods could take a hit as well.
Absolutely. And I do want to make a point also about the broader tech and growth space, because we saw the NASDAQ sell off pretty heavily on this, early in the days of this conflict. And I think it's worth noting, because tech is relatively insulated from this. They don't use oil for really a lot of their inputs, unless you're talking about maybe some of the hardware companies, but that's to a very, very small extent. That barely impacts their margins. They aren't shipping things. It's typically software, maybe some hardware suppliers, but this is mostly contained within the United States. So, the question is, why are these companies, why are semiconductor companies or why are software companies, selling off in the midst of this broader conflict? And I'll say this again, I've said it before on this podcast, is that investment markets do not like uncertainty. Whenever you have higher uncertainty, it raises the risk premium that you have to get on risky assets, and those include stocks and equities, of course. And so in order for investors to, buy equities, to put those in their portfolio, they're going to demand a higher return, which means you're going to have to see a slightly lower price in order to compensate for that. So that's what the market really did whenever it was selling, things like tech, things like growth stocks, is it's demanding more on that risk premia basis. Whether that's warranted or not is a whole nother question. I would say that this conflict never really appeared too dramatic or too drastic. So we weren't making broad portfolio changes. I think we'll get to what we've been doing in a second, but really taking advantage of opportunities like this whenever you see sell-offs in the market. If there is cash to allocate, it's a good time to buy into things that frankly are kind of just selling off for almost no reason. If you're very insulated from oil, from geopolitical events, from Middle Eastern economics, there's not really concern to see valuation decrease. Investors are going to, have that uncertainty for a certain period of time, and you're going to see a rotation of sell-off because of that. But we view those as very short-term in nature.
Yeah, I think that's a really good point because we saw momentum. Stocks was classified as momentum, particularly companies that have done well, get hit the most off of this news. And, it's been a very brief move on that, but it's kind of, to your point, Victor, that it's that reduction of people who are feeling really good about this, and then maybe that injects some just question marks when it comes to the risk premium thing. But I do agree with you that they are very insulated. So if you're looking at the underlying economics of these companies, none of that is changing based off of this. And then one more point I want to make, because I realized I neglected it while I was talking about industrials. Industrials also includes aerospace and defense companies, and those should be a huge benefactor of this. For better or worse, we're launching, most of these missiles are $1 million missiles that we're shooting, and we're going through them. Those will have to be replaced. This is increased maintenance on fighter jets, on all sorts of military assets. And so even though, that it's creating a whole bunch of backlog for those companies, for your traditional aerospace and defense companies, we saw those companies get hit on this news as well, which, kind of feeds into the idea that markets aren't always perfectly efficient. They're not always the most logical actors. Sometimes they like to press the sell button, and even companies who should be actively benefiting from this, those companies selling the goods with which to wage war, get hit negatively on news about war. So that's a very interesting space to keep an eye on, just because it's traded so kind of what I would call abnormally.
Right. And I think you have to, just as anything, whenever you're taking, investment approach, especially for us as long-term investors, is you have to look at the long-term picture. Is this going to create demand or remove demand for aerospace and defense companies? I think it's fairly definitive that you can say it increases demand for the products that they create. So I think that makes it a prudent investment opportunity in the long run. And what we'll get to in a second, though, I think is you have to be positioned ahead of events like this. Of course, we don't all know what the Department of War or the officials in the U.S. administration are looking to do on any given week. But I think you can view the tendencies and kind of position your portfolio ahead of time for things like this. And that's why we've owned aerospace and defense companies for quite some time with the anticipation of increased geopolitical conflicts. We've already seen this over the past several years. War across the world, popping up sporadically, and so I think that was a prudent investment back then. That's yielded benefits at this point.
Well, and I think too, to your point, is that if you pay attention to the geopolitical world, which doesn't always directly affect markets, but when it does, it really does. Many people were forecasting this weeks in advance. The administration likes to follow a playbook in a lot of these negotiations, and this one played out just about to the T of Donald Trump's playbook. And so, the negotiation rounds, the movement of military assets, you could see it coming, kind of. You never knew if it was actually going to amount to anything, but the signs are there if you're paying attention to them.
Absolutely. Now let's run quickly through some scenario analysis. It looks like so far, luckily, that this operation has been extremely successful so far for the United States and for its allies. And so I think we can kind of start with the base case is it doesn't appear that, the U.S. wants this to be a drawn-out conflict where they're boots on the ground. It looks like it's going to be short, a brief disruption. Already things are starting to shape up and improve in the Strait of Hormuz. So I think we can go ahead and say that our base case is that you have a short-term disruption in energy prices. Oil prices will stay elevated for some period as the market feels comfortable with the supply chain righting itself. But not being a drawn out situation or extremely elevated oil prices that would create significant disruptions to the U.S. economy, to the world economy, to inflation, and then Fed calculus on the back of that. So I think we can kind of just say that at least the base case looks like this is a brief disruption. Maybe another week and a half of higher volatility, but then things starting to sort themselves out from there.
Yeah, and really the takeaway from that scenario being kind of what we've hinted at before on this podcast of taking advantage of that volatility that the market gives you, because with the expectation that it's not going to last forever. I'd say the next scenario would be pretty similar, but that just remains drawn out for a little bit longer. Not necessarily that the conflict is as intense or as just impactful as it has been, but that the Strait of Hormuz stays either closed or economically difficult to navigate. And so you're adding those 10 to 14 days onto your supply routes. Brent stays in the, high 80s, 90s, even clipping $100 range for a little longer period of time. That will have a negative effect on growth once you're talking about maybe a month or two of this. And that's when you'd really start to see those upstream and midstream companies really produce a sizable return that actually create some economic benefits for them other than 1 or 2 days of heightened Brent prices. So that's kind of when you're looking at oil and gas as well as some more defensive options for the rest of your portfolio, kind of barbelling your risks there with your oil and gas exposure as well as, additional, whether it's fixed income, but, as we said before, fixed income has started trading with a higher correlation to equities. So maybe that's kind of buffered investments or structured notes, stuff like that hopefully portfolios are already containing to hedge against events like this.
Yeah, exactly. And I think that's the message that we want to convey throughout going through these scenarios is position your portfolio for an all-weather scenario. Of course, it helps to be active. And that's why we like to maintain active portfolios, is that if events really change, if say the second scenario all of a sudden looks more likely than our base case, we can pivot portfolios to some extent to adjust to that. But maintaining in the first place kind of an all-weather portfolio that is set up, that has some of those natural hedges. You mentioned structured notes, buffered investments, things that offer some protection, alongside avoiding the sectors of the economy that are overly exposed to situations like this can be beneficial. Now, getting back to our scenario analysis, I think at this point, it's fair to say we can take the most extreme negative scenario off the table. It looks like, based off of the way Iran's military has been crippled, we're not going to see significant infrastructure damage or, broader, intense disruptions to the strait, or significant oil price disruptions on the global stage. So I think we can remove the, highest risk, kind of worst case scenario off the table at this point. But I do think it's worth noting a positive tail scenario. Now, this would still take a little bit of time to run its course. But if you were to have, a relatively friendly, productive administration take place in Iran, and then all of a sudden they're ramping oil output, they're becoming, more amenable on the world stage, partnering with other economies, and they become, over time, something closer to, Saudi Arabia or a country like that. Of course, that's a longer track record, longer kind of outlook. But even in the near term, if you had, immediately a fairly stable regime take place, then you could see oil kind of resume its output and, normalize kind of back to a healthy level. So I think that's kind of your positive tail scenario where you kind of get this rampant oil supply and then prices are actually pushed down because of it. I view that as unlikely, and I'd probably stick with our base case, but I think it's worth mentioning.
Yeah, but I think that's a fair point because your negative tail risks, especially in this business, get highlighted way more than your positive tail risks. And this is one of those cases where I think, if anything, maybe your positive tail risk is a little bit more likely than that negative one that you're talking about. But both ways, I think we're kind of still looking in the middle. Base case making a lot of sense, just given how things have unfolded over the last few days even.
Yeah, and so that kind of brings us to essentially our wrap up is I think the way that you have to look at these situations, Rudy mentioned being allocated, properly in advance so your portfolios can withstand something like this, but also, avoiding the emotional component that comes with events like this. We've seen a lot of geopolitical flashpoints and, major headlines that pop up, and it's really, it's our job to separate the signal from the noise, understand what is going to have longer, broader impacts on markets versus what's going to create a one-day disruption. And then the second part of that is, what do you do with these one-day or one-week disruptions? You do your best to take advantage of them. So, what we've been doing on, sharp weakness is we've been investing in companies that we view that have, long-term profitability, growing earnings, proper valuations, things that are insulated from this event, itself. And we feel comfortable doing that, especially as long-term investors in this situation. So you really try to take advantage of this stuff as much as possible rather than let it impact your decision-making.
Mm-hmm. And one thing I want to stress to the audience is that in events like this, and certainly this episode, we've talked a lot about being prepared for these things. And, that sounds great. Wish I could have, gone back in time and done something about it ahead of time. But, just the idea that this is a relatively small event in the broad scheme as far as, market consternation or market events really go. And so unfortunately, it won't be the last one. And so just kind of that encouragement to, it doesn't always have to be you prepared for this one, but you can always put yourself in a position to prepare for the next one. I hope that one next big market freak out isn't for a little while here, or at least for a long while if possible. But the unfortunate reality is it will happen again, to whether it's another war or some other economic issue. Just that being prepared, it's never a bad time to start getting prepared. So even if you weren't necessarily prepared for this one, you can always be prepared for the next one.
Yeah, extremely well put, Hunter. It's been great breaking this down with you today. Of course, we're going to continue to watch it. We're going to continue to issue intelligence through our website, through email that covers these topics. We may even have a follow-up episode if necessary, but I think hopefully we gave our listeners something valuable to hear from us today.
Thanks, Victor.